If you've ever wanted to turn a small amount of money into a significant gain in the crypto market, futures trading is the tool that can make it happen, but it's also the fastest way to lose everything if you don't have a plan. Unlike spot trading where you simply buy an asset and wait for it to go up, futures trading allows you to speculate on price movement in both directions, meaning you can make money when the market is crashing just as easily as when it's mooning. But before you touch a single dollar, you need to understand the mechanics of leverage. Think of leverage as a loan from the exchange that amplifies your buying power. If you use 10x leverage, a 1% move in the market becomes a 10% gain for you. However, the inverse is also true, a 1% move against you results in a 10% loss. This is why beginners often get liquidated. They see the potential for massive gains and ignore the fact that the higher the leverage, the closer their liquidation price sits to their entry. To take a successful entry, you must move away from gambling and toward technical analysis. You never want to enter a trade just because you feel like the price is too high or too low. Instead, look for confluence. This means finding multiple reasons to take a trade. For a long position, you might look for the price hitting a major support level while the relative strength index shows it's oversold. For a short position, you'd look for the price hitting a resistance ceiling or a bearish divergence on the volume charts. Once you identify a high probability zone, you need to decide between a market order or a limit order. A market order gets you in instantly at the current price, which is good for fast-moving breakouts, but a limit order allows you to set the specific price you want, often saving you money on fees and ensuring you don't get caught in a wick that immediately reverses. Now, the most critical part of your setup isn't the entry, it's the stop loss. If you trade without a stop loss, you aren't a trader, you're a gambler waiting for a disaster. A stop loss is an automated instruction to the exchange to close your position if the market hits a certain price, preventing further losses. The key is to place your stop loss just outside the invalidated zone. For example, if you are long because the price is above a support line, your stop loss should be slightly below that line. If the price breaks that support, your reason for being in the trade is gone, and the stop loss saves your capital so you can live to trade another day. A common mistake is moving your stop loss further away as the price approaches it because you're afraid to realize a loss. Never do this. Respect your original analysis and let the stop loss do its job. Knowing when to exit and take profits is what separates the professionals from the dreamers. Many traders find themselves deep in profit, only to watch the market reverse and turn that gain into a loss because they got greedy. The best way to manage this is through take-profit targets. Before you even enter the trade, identify the next major resistance levels or previous highs. You can set multiple take-profit orders to scale out of your position. For instance, close 50% of your trade at the first target to lock in gains and move your stop loss to your entry price. This creates a risk-free trade where even if the market turns around, you've already made some money and won't lose your initial investment. By taking profits incrementally, you capture the meat of the move while leaving a small portion running just in case the market goes into a massive parabolic run. To actually make consistent profits from futures, you must master the concept of the risk-to-reward ratio. You should always aim for a ratio of at least 1 to 2 or 1 to 3. This means that for every dollar you risk losing, you stand to make $2 or $3 in profit. If you consistently take trades with this ratio, you can actually be wrong more than half the time and still be a profitable trader in the long run. Most beginners do the opposite, they hold on to losing trades for a long time hoping they'll come back, while cutting their winning trades early out of fear. You have to flip that psychology. Let your winners run to your targets and cut your losers quickly. Finally, you need to manage your emotions and your margin type. You'll see options for cross margin and isolated margin. For beginners, isolated margin is almost always the better choice because it limits your risk to only the amount of money you put into that specific trade. If things go horribly wrong, you only lose that stake, not your entire account balance. Cross margin uses your whole wallet as collateral, which can lead to total account wipeouts if one trade goes rogue. Remember, futures trading is a marathon, not a sprint. The goal is to stay in the game long enough to develop the skills and intuition required to read the charts. Start small, use low leverage, and